Hey everybody, Jon Grauman from Resident here. I want to give you a market update looking back on the first 4 months of 2026. Now, the question I get asked more than any other is, how's the market doing? And it's obviously a big, loaded question. There are so many different factors and variables that influence how the market is performing from one market to the next. Today, I want to spend a little bit of time focusing on what some of those key indicators are. I'm going to try to break them down as concisely as I can. Bear in mind, these are nationwide averages, so you have to take an appropriate size grain of salt to apply it to whatever your respective market is. Also, I don't mean to sound like a doomsdayer or a naysayer. I'm not an alarmist. These are just the facts, and I just want to sort of go through them with you kind of one by one. So the year didn't get off to the start that I think most people were expecting or hoping for, and that can be attributed to probably two things primarily. One, the war. Two, the weather. No one expected us to be at war with Iran. And secondly, there was a lot of nasty weather going around the country in the first quarter of 2026. I think those two variables really slowed down the market. Early projections are signaling that we're likely going to see negative GDP, that is the gross domestic product, for Q1 of 2026, which is not entirely surprising when you consider all the circumstances. Oil prices are at a 4-year high. Inflation is at 3.3%, largely in part due to these higher energy costs. In spite of all that, the stock market is continuing to perform very well. Unemployment's only at 4.3%, although 25% of those people that are unemployed have yet to find a new job in the last 6 months. So AI is certainly having an impact there. Wages are still growing at a rate that is higher than that of inflation, although it doesn't feel that way to most people. The consumer sentiment index is at an all-time low, consumer spending is down, and perhaps most importantly, the consumer debt is at a record high of $18.8 trillion. This is the worst affordability crisis we've seen in 40 years, and that's back when interest rates were in the mid to high teens. Now, if we want to look at some stats specific to the housing market, again, none of this is particularly surprising and therefore shouldn't be alarming, but it starts to tell a pretty compelling story when you look at it succinctly like this. Pending sales are down, new home sales are down, mortgage applications are down, permitting activity is down, March sales year over year going back to 2025 is down. Again, not surprising, but what does all of this mean and what does it mean to you? It means that if you're a seller in this market, you need to be very realistic about what this market is and how you're positioning yourself. Don't try to compare it to last year's market or last month's market or the 2021 market. This is this market. And as we are now in Q2, heaven forbid, if we were to have a negative GDP in Q2, technically by definition, that would become a recession. And then you have to start thinking about all the sensationalism that would go into that and what that might do to the economy and the sort of ripple effect of that. So again, not trying to put that out there. Hopefully that doesn't come to be, but it's important to consider all of these different factors. So I'm here to provide insight and guidance. If you have any questions, please make sure to DM me and I'll see you on the next update.